Back in the year 1772, something absolutely insane happened in Amsterdam that most people have never even heard of. And it's gonna make what just happened in Japan make a whole lot more sense. There was this thing called the Amsterdam Whistle Bank, basically the most powerful bank in Europe at the time. And for over 150 years, everyone thought their money was completely safe there. The bank claimed they had full backing in metal, gold, and silver, sitting in their vaults. But here's the thing, they were lying. For decades, they'd been secretly lending out the deposits to the Dutch East India Company, creating money that didn't actually exist. When people finally figured it out in 1772, the entire financial system of Amsterdam collapsed practically overnight. Fortunes that took generations to build vanished in weeks. And the craziest part? The people running the bank walked away mostly fine, while regular depositors lost everything. My name is David, and I spend way too much time thinking about how central banks manipulate entire economies while pretending they're acting in your best interest. If you're someone who's tired of hearing the same recycled financial advice that never actually helps you build real wealth, and you're looking for someone to actually explain what's happening behind the curtain without the typical Wall Street nonsense, subscribe and like this video. It will help more than you think. And honestly, this stuff matters way more to your financial future than whatever stock tip you heard last week. By the end of this video, you'll understand the exact mechanism that Japan's central bank has been using for 3 decades to manipulate global interest rates, how it's kept your savings account basically worthless, and why the decision they just made is going to reshape the entire global financial system in ways most financial advisors either don't understand or won't tell you about. So let me take you back to that moment in Amsterdam, because understanding what happened there is the key to understanding what's happening right now. Picture this. It's the early 1700s, and Amsterdam is basically the financial capital of the world. The Whistle Bank isn't just any bank, it's the bank. Merchants, governments, wealthy families, they all kept their money there because the bank had this reputation for being completely safe. They claimed that every guilder deposited was backed by actual metal in their vault. 100% reserve backing. You put in 100 guilders, there's 100 guilders worth of gold sitting there. That was the promise. And for over a century, everyone believed it. But here's what was really happening. Starting around the late 1600s, the Dutch East India Company needed massive amounts of capital to fund their trading operations. We're talking about ships, warehouses, armies, entire colonial operations. And the Whistle Bank started secretly lending them money from the deposits. Not their own capital, the deposits. The money that was supposed to be sitting safely in the vault. Now, why would they do this? Simple. The people running the bank were also the people who had massive stakes in the Dutch East India Company. They weren't trying to serve their depositors. They were trying to enrich themselves. So step 1, they take depositor money and lend it to the company. Step 2, the company uses that money to expand operations and generate profits. Step 3, those profits flow back to the insiders who own the company stock. Step 4, they keep doing this over and over, creating more and more unbacked credit, betting that depositors will never all show up at once asking for their money back. But here's the catch. This only works as long as confidence remains high. The second people start to doubt the bank, the whole thing unravels. And that's exactly what happened. By 1772, rumors started spreading that the bank didn't actually have the reserves they claimed. People started withdrawing money. The bank couldn't meet the demands. And when they finally had to admit the truth, the entire system collapsed. We're talking about something like 40 million guilders in losses, which in today's money would be multiple billions. Banks across Europe that had trusted the Whistle Bank got wiped out. Merchants went bankrupt. Regular people who thought their savings were safe lost everything. Why would they do this? Because the people in charge weren't thinking about the depositors. They were thinking about themselves and their friends who owned shares in the trading company. When the crisis hit, those insiders had already extracted their wealth. They owned estates, land, businesses. Meanwhile, the regular depositors were left holding worthless paper claims. And here's the aftermath. The people who ran the bank, most of them faced basically no consequences. Some mild embarrassment, maybe. But they kept their wealth. The depositors? Gone. Years of savings, inheritances, business capital, all of it just evaporated. And here's the kicker. The real winners were the people who understood what was happening early and got their money out first. The insiders and the well-connected. They saw the warning signs, quietly withdrew their funds, and left everyone else holding the bag. So what does this have to do with Japan ending zero interest rates after 30 years? Everything. Just like the Whistle Bank profited from creating unbacked money and hiding the truth from depositors, the Bank of Japan has been profiting from manipulating interest rates and hiding the true costs from savers and workers. And just like in Amsterdam, when the music finally stops, the insiders will be fine and regular people will pay the price. Let me give you a modern version of this that'll make it crystal clear. Imagine you've got a savings account at your local bank with $10,000 in it. You're earning basically nothing in interest, maybe 0.01% a year, so like $1. Meanwhile, the bank takes your $10,000 and lends it to someone else at 5% interest. They're making $500 a year on your money. You get $1, they keep $499. You feel like your money is safe because the bank has a nice building and the FDIC backs it, but you're getting destroyed by inflation. Every year, your $10,000 buys less and less stuff. Bread costs more, gas costs more, rent costs more. Your account balance says $10,000, but in real purchasing power, it's maybe worth $9,500, then $9,000, then $8,500. Now imagine the bank is doing this not just with your $10,000, but with billions of dollars from millions of people. And imagine they're not doing it by accident. They're doing it on purpose, working directly with the central bank to keep interest rates artificially low so they can borrow cheap money from savers and lend it out at higher rates. You're not just losing purchasing power by accident. You're being systematically transferred wealth from, and you don't even realize it's happening because the number in your account stays the same. That's exactly what's been happening in Japan for 30 years, except instead of your local bank, it's the entire Bank of Japan doing it to the entire country. And instead of just your $10,000, we're talking about trillions of yen in savings being slowly bled dry while the people running the system told everyone this was necessary for economic growth. Here's where it gets really interesting. Because the villain in this story isn't some mustache-twirling evil banker. It's actually a whole system of central bankers, government officials, and large financial institutions who genuinely convinced themselves they were doing the right thing while simultaneously benefiting massively from the policy. Let me introduce you to the antagonist, and it's bigger than one person. It's the entire framework of modern central banking that emerged after World War II, but specifically, the Bank of Japan took it to an extreme that no one else dared to try until recently. Back in 1991, Japan's asset bubble popped. Real estate prices that had gone absolutely insane. We're talking about the land under the Imperial Palace in Tokyo being theoretically worth more than the entire state of California. All of that came crashing down. Stock market lost half its value. Banks were holding trillions of yen in bad loans. The normal response would have been to let those banks fail, let the bad debt get wiped out, take the pain, and rebuild. But that's not what happened. Instead, the Bank of Japan, along with the government, decided they were going to fight deflation and economic stagnation by dropping interest rates to basically zero and keeping them there. Now, why would they do this? The official story is that low interest rates encourage borrowing and spending, which stimulates the economy. If money is cheap to borrow, businesses will invest, consumers will buy houses and cars, and economic growth will return. That's the theory. But here's the real motive. And this is where most people get lost because they take the official explanation at face value. The real reason to keep rates at zero was to protect the banks and the large corporations that were drowning in bad debt. Think about it this way. If you're a bank and you made a bunch of stupid loans in the 80s that are now worthless, you've got two options. Option one, admit the loans are bad, write them off, take the loss, maybe go bankrupt. Option two, Convince the central bank to drop interest rates to zero so you can borrow money for free. Use that free money to slowly earn your way out of the hole over decades and never actually admit you made a mistake. Japan chose option 2. The Bank of Japan dropped rates to zero in 1999 and kept them there for 25 years. Then they went even further and pushed rates into negative territory in 2016, meaning banks had to pay the central bank to hold their reserves. This is insane when you think about it. You're literally being charged to save money in the safest possible place. Now, who benefits from this? Not savers. If you're a regular person in Japan trying to save for retirement, you've earned basically nothing on your savings for 3 decades. 1 million yen in a savings account in 1990 would still be 1 million yen today, but it buys maybe 60 or 70% of what it used to. You've been quietly robbed by inflation while your account balance stayed the same. But if you're a bank or a big corporation with access to cheap credit, you've made out like a bandit. You can borrow at near 0%. Invest that money in anything that yields more than zero. Stocks, real estate overseas, corporate bonds in other countries, and pocket the difference. It's free money for the people who already have money. And here's how they hide it. They use 3 main tactics. First, they focus all the public messaging on inflation, targeting, and economic growth. They say, we're doing this to help the economy, to create jobs, to prevent deflation. And those things sound good, so most people don't question it. Second, they make the mechanism incredibly complex. They talk about quantitative easing, yield curve control, monetary base expansion. All this jargon that makes regular people's eyes glaze over. If you can't understand it, you can't criticize it. Third, and this is the sneakiest part, they point to the stock market as proof it's working. The Nikkei index goes up, and they say, see, the policy is successful. But who owns stocks? Not regular workers. The wealthy and corporations. So the policy inflates asset prices, which makes the rich richer while doing nothing for regular people's wages. And then they point to the asset price inflation as evidence of success. Here's the emotional reframe you need to understand. You're not a victim of some inevitable economic force. You're a player in a game where the rules were written by people who benefit from you not understanding them. The central bank isn't some neutral referee. They're actively picking winners and losers. And for 30 years in Japan, savers and workers were the designated losers, while banks and large corporations were the winners. Now you're asking yourself, okay, so if this has been going on for 30 years, why did Japan just end it? What changed? And this is where it gets really interesting, because the answer reveals something most financial media isn't talking about. Japan didn't end zero rates because they suddenly decided it was unfair to savers. They didn't end it because they had some moral awakening about wealth inequality. They ended it because they had no choice. The policy was starting to destroy the currency itself. Let me explain what I mean. When you keep interest rates at zero for 30 years, while other countries have higher rates, money flows out of your country to chase those higher returns. Investors take their yen, convert it to dollars or euros, and invest overseas. This puts downward pressure on your currency. For a while, Japan actually liked this because a weak yen made their exports cheaper and more competitive. Toyota and Sony loved it. But here's the problem. Japan imports almost all of its energy. Oil, natural gas, coal, all of it comes from overseas and is priced in dollars. When the yen weakens too much, the cost of those imports goes through the roof. By 2023, the yen had weakened so much that Japan was facing serious inflation for the first time in decades. Not the gentle 2% inflation central banks claim to want, but real inflation that was hurting regular people's ability to buy food and heat their homes. Energy import costs were up 40, 50% in some cases. At the same time, the gap between Japan's zero rates and US rates, which had gone up to 5% plus, was so wide that it created massive currency speculation. Hedge funds and traders were doing what's called the carry trade. They'd borrow yen at 0%, convert it to dollars, buy US Treasury bonds yielding 5%, and pocket the difference. Risk-free profit. But this was putting even more pressure on the yen to weaken. The Bank of Japan was trapped. If they kept rates at zero, the yen would continue to collapse and import costs would destroy their economy. If they raised rates, they'd pop the massive asset bubbles they'd spent 30 years inflating. In March 2024, they finally blinked. They raised rates for the first time in 17 years, moving from negative 0.1% to a range of 0 to 0.1%. Then, in July 2024, they raised again to 0.25%. Doesn't sound like much, right? A quarter of 1%? But this is a massive deal. It's the first time since 1999 that Japan has had positive interest rates. And the signal it sends is huge. It tells the market that the era of free money is over. Now you might be thinking, okay, so what? Japan raised rates a tiny bit. How does that affect me? I live in the US. I don't own yen. And this is where most people miss the connection. Here's the thing. Japan has been the piggy bank for global speculation for decades. Because you could borrow yen at 0%, trillions of dollars worth of yen were borrowed and invested all over the world. In US stocks, in emerging market bonds, in real estate from London to Sydney. That borrowed yen money has been inflating asset prices globally. When Japan raises rates, even a little, it makes the carry trade less profitable. Traders start to unwind those positions. They sell the US stocks they bought with borrowed yen, they sell the real estate, they convert dollars back to yen to pay off the loans. This creates selling pressure on all those assets. In August 2024, right after Japan raised rates to 0.25%, global stock markets had one of their worst days in years. The Nikkei dropped over 12% in a single day. The S&P 500 dropped over 3%. The Nasdaq got hammered. And the media talked about it like it was some random volatility, maybe recession fears or weak economic data. But the real trigger was the unwinding of the yen carry trade. Billions of dollars of leveraged positions getting liquidated all at once. Now, let me give you the math on why this matters to your portfolio, even if you don't think you're exposed to Japan. Let's say you've got $100,000 invested in an S&P 500 index fund. Seems safe, right? Diversified across 500 companies. But here's what you might not know. A significant portion of the buying pressure that pushed the S&P to record highs over the past decade came from leverage, from borrowed money. And a chunk of that borrowed money was yen borrowed at 0%. When that leverage unwinds, it doesn't matter how good the underlying companies are. The selling pressure from forced liquidations drives prices down. Your $100,000 portfolio could drop to $90,000 or $85,000 not because the companies got worse, but because the financial plumbing that was inflating prices is reversing. Let me make this even more concrete. Back in the 2000s, before the financial crisis, there was something like $2 trillion worth of yen carry trades outstanding. That's money borrowed in yen and invested elsewhere. When Japan raised rates slightly in 2006 and 2007, some of that trade started to unwind, and it contributed to the volatility that preceded the 2008 crash. Now, estimates are that there's even more carry trade money out there today, maybe $3 or $4 trillion. We don't know the exact number because a lot of it is hidden in derivatives and hedge fund positions that aren't publicly reported. But if even half of that unwinds over the next year or two as Japan continues to normalize rates, we're talking about trillions of dollars of selling pressure hitting global markets. And here's the psychology behind it. For 30 years, an entire generation of traders and investors has operated in a world where Japan was always the source of free money. They built their entire investment strategies around the assumption that yen borrowing costs would stay at zero forever. It became so normal that people stopped even thinking about it as a risk. It was just how the world worked. But now that assumption is breaking. And when a core assumption that underlies trillions of dollars of investments breaks, people panic. They don't carefully analyze and slowly adjust. They hit the sell button and ask questions later. This is where it gets really interesting because we're not just talking about market volatility. We're talking about a fundamental shift in how global finance works. For the past 30 years, the world has had three major central banks: the Federal Reserve, the European Central Bank, and the Bank of Japan. The Fed and ECB would occasionally raise and lower rates based on their economic conditions, but Japan was always the anchor. No matter what happened, you could always borrow yen for free. That allowed global banks and investors to maintain leverage even when other sources of cheap money dried up. Now that anchor is gone, Japan is normalizing. And this is happening at the same time that the Fed is potentially stuck with higher rates because of inflation, and the ECB is dealing with its own structural problems in Europe. There's no easy source of free money anymore, and an entire global financial system that was built on the assumption of endless cheap credit has to adjust. That adjustment is going to be painful. Some hedge funds will blow up. Some banks will report massive losses on positions that were assumed to be safe. Some real estate markets that were propped up by cheap foreign money will crash. But now you might think, well, isn't this a good thing? Shouldn't we want interest rates to be normal? Shouldn't savers finally get rewarded for saving? And you're absolutely right. In a sane world, this would be good. The problem is, we don't live in a sane world anymore. We live in a world where 30 years of zero rates created dependencies and distortions that can't be unwound without pain. Let me give you an analogy that might make this clearer. Imagine you've been taking a painkiller every single day for 30 years. Not because you're in acute pain, but because you started taking it for an injury decades ago, and you just never stopped. Your body has adapted to always having that drug in your system. Your brain chemistry has changed. Your pain receptors have adjusted. And now, if you try to stop taking the painkiller, you're going to go through withdrawal. It doesn't matter that living without the painkiller is healthier in the long run. The withdrawal process is going to hurt a lot. And there's a real risk that during withdrawal, you'll make bad decisions because you're desperate to make the pain stop. That's where the global financial system is right now. Japan's zero rates were the painkiller. The global economy adapted to it. Corporate balance sheets, government debt levels, asset prices, all of it got structured around the assumption of perpetual cheap money. And now the painkiller is being taken away. The withdrawal is going to be brutal. And during that withdrawal, there's going to be a desperate temptation to do something, anything, to make the pain stop, which probably means other central banks will be pressured to cut rates again, to print more money, to find some new version of the same drug. Here's what most people don't understand about central bank policy. It's not science. It's not some precise technical tool where you turn a dial and get a predictable result. It's closer to gambling. They try something, see what happens, and then react to the consequences. Japan tried zero rates to solve their 1990s crisis. It didn't solve the crisis. It just delayed the pain and created new problems. Now they're trying to exit zero rates. That's going to create different problems. And they'll try something else to solve those. It's an endless cycle of intervention, creating distortions, which require more intervention, which create more distortions. And the people who pay the price for this cycle aren't the central bankers. They keep their jobs, their pensions, their reputations as serious experts. The people who pay are regular savers who earn nothing for 30 years, workers whose wages stagnated while asset prices inflated, young people who can't afford to buy a home because cheap money inflated real estate prices beyond any connection to actual incomes. Now you're asking yourself, so what do I actually do about this? How do I protect myself? And this is the part where I'm going to give you specific, actionable steps, not vague advice like be diversified or stay informed, but actual tactical moves you can make. Action step 1. Understand your exposure to leverage in your portfolio right now, today. If you own index funds, which most people do, you need to understand that a portion of those funds' returns over the past decade came not from organic business growth, but from multiple expansion driven by cheap money. When a company's stock goes from a price to earnings ratio of 15 to a ratio of 25, that's not because the company got better. It's because investors were willing to pay more per dollar of earnings because money was cheap. As money gets expensive again, those multiples compress. A stock trading at 25 times earnings might drop to 18 times earnings, even if the company's actual earnings don't change. That's a 28% drop in stock price with zero change in the underlying business. Go look at your portfolio right now. Find out what the average PE ratio is for the funds you own. If it's above 20, you're exposed. If it's above 25, you're very exposed. The historical average PE for the S&P 500 is around 15 to 16. We've been above 20 for years now because of cheap money. As that cheap money disappears, reversion to the mean is likely. That doesn't mean sell everything. It means understand that a chunk of your portfolio's value is based on financial engineering, not business fundamentals. Position accordingly. Action step 2. Build a cash position in something that actually holds value. And I'm not talking about stuffing money under your mattress. Here's what I mean. For 30 years, holding cash was the dumbest thing you could do because it earned nothing and inflation ate away at it. But now, in a world where Japan is normalizing rates, where the Fed might have to keep rates higher for longer, where there's going to be market volatility and forced selling, cash becomes powerful. Not because it earns a great return, but because it gives you optionality. When everyone else is forced to sell assets to meet margin calls or redemptions, you can buy, but here's the key. You need to hold that cash in something that's actually protected from currency debasement. I'm talking about short-term US Treasury bills if you're in the US, currently yielding around 5%. That's 5% risk-free, backed by the full faith and credit of the US government. Compare that to Japan, where savers earned 0 for 3 decades. T-bills aren't sexy. They're not going to double your money, but they give you a return above inflation, they're liquid, and they position you to take advantage when opportunities appear. And those opportunities are coming. When the yen carry trade fully unwinds, when some over-leveraged hedge fund blows up, when some real estate market that was propped up by foreign money crashes, you'll be able to step in and buy assets at rational prices. Action step 3, and this is the one most people won't do because it requires actual psychological work. You need to divorce your sense of financial success from short-term market movements. Here's the psychological trap that the system sets for you. Every day, you can check your portfolio balance. Every day, the number changes. Green days feel good, red days feel bad, and your brain starts to associate your self-worth with whether the line goes up or down. This is by design. It keeps you engaged, keeps you trading, keeps you generating fees for the financial industry. But here's the reality. Over the next 2 to 5 years, as the global financial system adjusts to the end of Japan's free money, markets are going to be volatile. There will be big down days, maybe even a bear market where stocks drop 20, 30, 40% from peak to trough. If you're psychologically dependent on the line always going up, you're going to make terrible decisions. You'll panic sell at the bottom. You'll buy garbage at the top because you can't stand being out of the market. You'll destroy your wealth trying to avoid the normal pain of market cycles. The action step is to set a schedule where you check your portfolio no more than once a quarter. That's it, 4 times a year. You rebalance if needed, make sure your allocation still makes sense, and then you close the app and go live your life. This is brutally hard for most people because we're addicted to the dopamine hit of checking our accounts. But the investors who will thrive over the next decade are the ones who can sit still, who can watch everyone else panic and not join them, who can see assets go on sale and have the emotional discipline to buy when it feels terrifying. I've watched people destroy 6-figure portfolios over the past 20 years by trading based on fear and greed. Someone builds up $200,000 through steady contributions and basic index investing. Then there's a market crash. They panic, sell everything, swear they'll get back in when things calm down. Things calm down. Months pass. The market recovers and goes higher. Now they're afraid to buy back in because they feel like they missed it. They sit in cash, earning nothing. Meanwhile, inflation is eating their purchasing power. A year later, that 200,000 has the buying power of 180,000, and they haven't participated in any of the market recovery, all because they couldn't handle the emotional discomfort of short-term volatility. Here's something else you need to understand about what's happening with Japan. This isn't just about interest rates. It's about the end of an era where central banks could paper over every problem by printing money. From 2008 to 2020, the playbook was simple. Economic crisis, print money and drop rates. Market crash, print money and drop rates. Pandemic, print money and drop rates. And it worked, sort of. It prevented immediate collapse, but it created asset bubbles, massive wealth inequality, zombie companies that should have failed but survived on cheap debt, and a whole generation of investors who thought the Fed and other central banks had abolished the business cycle. Japan is the canary in the coal mine. They took that playbook to the extreme, ran it for 30 years, and now they're being forced to exit because the side effects became worse than the original disease. The yen was collapsing. Inflation was hurting regular people. The entire country was becoming a piggy bank for global speculators. They had no choice but to raise rates. And now other central banks are watching nervously because they're in a similar trap. They've got massive debt levels, inflated asset prices, and economies that have become dependent on cheap money. But they've also got inflation, currency concerns, and a public that's getting angry about inequality. The Fed wants to cut rates to support the economy, but they're scared of reigniting inflation. The ECB wants to cut rates to help struggling European economies, but they're scared of the euro weakening too much. The Bank of Japan just raised rates, but they're scared of crashing their stock market and real estate market. Everyone is trapped. And the trap was built over decades of using monetary policy to avoid short-term pain while building up long-term distortions. Now, let me tell you who's going to win in this environment, because it's not random and it's not fair. The people who are going to win are the ones who understand that we're shifting from an era where everything went up together to an era where you have to be selective. For the past 15 years, you could throw a dart at a list of stocks and probably make money because the tide of cheap money lifted all boats. That era is over. Going forward, there's going to be massive dispersion between winners and losers. Companies with strong balance sheets, low debt, real pricing power, they'll do fine or even thrive. Companies that survived on cheap debt, that have business models dependent on low rates, they're going to struggle or die. Real estate in areas with strong organic demand and limited supply will hold value. Real estate in areas that were bid up by speculative foreign money is going to crash. Investors who can tell the difference, who can analyze actual fundamentals instead of just buying indexes and hoping they're going to build wealth. Everyone else is going to watch their net worth stagnate or decline. And here's the really uncomfortable truth that no one wants to say out loud. The system is designed to transfer wealth from the unsophisticated to the sophisticated during times of transition. When markets are calm and going up, everyone makes money and no one asks questions. But when volatility hits, when the rules change, when old playbooks stop working, that's when wealth gets redistributed. The people who understand what's happening, who have cash, who aren't over-leveraged, who can think clearly while everyone else panics, they accumulate assets at bargain prices. The people who don't understand, who are forced to sell at the wrong time, who make emotional decisions, they lose. This happened in 2008. Regular people lost their homes, their retirement accounts got cut in half, unemployment spiked. But some investors, the ones who understood the housing bubble was unsustainable, who positioned themselves to benefit from the crash, they made billions. Some hedge funds returned 50%, 100%, 200% in 2008, while the average investor lost 40%. It's going to happen again, because the mechanics of market crashes always create the same dynamic. Here's what I want you to take away from this. Japan ending zero interest rates isn't just some technical policy change in a foreign country. It's a signal that the global financial regime that's been in place since the financial crisis is breaking down. For 30 years, Japan provided free money to the world. That era is over. For 15 years, central banks everywhere convinced markets they could prevent any serious downturn. That era is ending too. We're entering a period where old assumptions are going to be tested and broken. Asset prices that made no sense are going to correct. Leverage that seems safe is going to blow up. Strategies that worked for a decade are going to fail. If you understand this, if you prepare for it, you're going to be positioned to thrive. If you ignore it, if you assume the last 15 years are normal and will continue forever, You're going to be one of the people wondering what happened when your portfolio is down 30% and your home value has dropped and your job is at risk because the economy is contracting. I'm not saying this to scare you. I'm saying it because it's the truth. And the truth is more valuable than false comfort. The financial media is going to tell you everything is fine, buy the dip, stay invested, trust the process. And maybe it will be fine. Maybe central banks will find some new trick to keep the plates spinning, but maybe they won't. And if they don't, the people who prepared, who built cash positions, who reduced leverage, who educated themselves on what's actually happening instead of just listening to cheerleaders, those people are going to come out ahead. Look, I started this video talking about Amsterdam in 1772 because I wanted you to see the pattern. Central banks and large financial institutions create systems that benefit themselves while telling the public it's for the greater good. They hide the risks, they use complexity to obscure what's really happening, and when it all blows up, the insiders walk away fine while regular people pay the price. That pattern has repeated over and over throughout history. The South Sea Bubble, the Mississippi Company, the Panic of 1893, the Great Depression, the stagflation of the 70s, the dot-com crash, the financial crisis. And it's happening again right now with the end of Japan's zero-rate policy. The difference this time is that you have access to information that previous generations didn't. You can educate yourself. You can see the warning signs. You can position yourself to be one of the people who benefits instead of one of the people who gets destroyed. But you have to actually do it. You have to take action. You have to be willing to think differently than the crowd, to question the narratives you're being fed, to sit still when everyone else is panicking, or to act when everyone else is complacent. Japan just made a move that's going to reshape global finance. Most people will ignore it or not understand it until it's too late. You don't have to be most people. You can be the person who saw it coming, who prepared, who positioned